What if I told you there's an investing strategy that almost guarantees you'll end up with less money than if you did nothing special, and that it's still the smartest move for most people? That strategy is dollar cost averaging. By the end of this video, you'll understand why it works, when it doesn't, and how to use it to build real wealth without losing sleep. You've probably heard the advice, buy low, sell high. Sounds simple, right? But here's the thing, even the pros can't do it consistently. In fact, most professional fund managers fail to beat the market over time. So if they can't time it, what chance do you have? The problem is that our emotions get in the way. When prices are dropping, we panic and sell. When they're soaring, we get greedy and buy. That's the exact opposite of what we should do. Dollar cost averaging is a way to take emotions out of the equation. You invest a fixed amount at regular intervals, no matter what. It's not flashy, but it works, and you might already be doing it without realizing it. Most 401k plans use dollar cost averaging automatically through regular payroll deductions. If you have a job with a 401k, you're already using it. But understanding why it works can help you stick with it when the market gets rough. Dollar cost averaging means investing the same amount of money at regular times, regardless of market conditions. You don't try to predict what the market will do. You just invest. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this can lower your average cost per share. Think of it like filling a bathtub with the tap running at a steady rate. Sometimes the water level drops a bit, but you keep adding water. Eventually, the tub fills up. You don't stop because the level dipped. You keep going. That's the idea. It's simple, but it's powerful because it removes the pressure of trying to time the market, something that's nearly impossible even for professionals. And you can do it with any amount of money. Many brokerages allow automatic purchases with no commission, so you can start with as little as $50 a month. DCA can be used with ETFs, mutual funds, and even individual stocks. It works because you're consistently buying, no matter what the headlines say. That consistency is what makes it so effective for beginners. Here's where it gets interesting. A Vanguard study looked at how often lump sum investing beat DCA. Over 6 months, lump sum won 64% of the time. Over 36 months, it won 92% of the time. Those are big numbers, so why bother with DCA at all? Because those are averages. The risk is that you invest your lump sum right before a crash. In 2008, a $100,000 lump sum invested at the start of the year would have fallen to about $61,500. With DCA, the loss was only about 26%. That's a huge difference in peace of mind. And over the long term, the gap shrinks. Over 20 years from 2001 to 2020, a lump sum grew to $135,471, while DCA reached $134,856. The difference? Less than $1,000. So DCA doesn't cost you much in potential gains, but it saves you from devastating losses. Another study by Morningstar looked at rolling 10-year periods from 1926 to 2019. They found that DCA resulted in less wealth than lump sum 90% of the time. So yes, lump sum wins most of the time, but that 10% where it doesn't, that's when you invest right before a crash. DCA protects you from that worst-case scenario. It's like insurance. You hope you never need it, but when you do, it's invaluable. The real power of DCA isn't mathematical, it's behavioral. It keeps you invested. When the market drops, your automatic investment buys more shares at a discount. You don't have to make a tough decision. It's already made. Studies show that individual investors often earn less than the funds they invest in because they buy high and sell low. DCA breaks that cycle. It's like having a personal trainer who makes you show up to the gym even when you don't feel it. You might not want to invest when the news is scary, but your automatic plan does it anyway. That discipline is worth more than a few percentage points of theoretical return. DCA reduces emotional decision-making by automating your investments. Emotions like fear and greed often lead to bad choices. DCA helps you stay disciplined. It's not about being a genius. It's about being consistent. And consistency is what builds wealth over time. Think of it as a savings habit that grows your money without requiring any effort after setup. The hardest part is starting, but once you automate, it becomes effortless. Getting started is easier than you think. Most brokerages let you set up automatic purchases of ETFs or mutual funds with no commission. You can start with as little as $50 a month. Just pick a low-cost index fund that tracks the S&P 500 or the total stock market, then set up a recurring transfer from your bank account. That's it. You're now a dollar-cost averager. If you have a 401k at work, you're already doing it. Payroll deductions are DCA. The key is to start early and stay disciplined. Compound interest does the heavy lifting over decades. A 20-year-old who invests $200 a month could have over $500,000 by retirement, assuming historical returns, but only if they stick with it. You can also use DCA with ETFs, mutual funds, and even individual stocks. Many brokerages allow automatic purchases with no commission, making it accessible for young investors. The hardest part is starting. Once you automate it, you barely notice the money leaving your account, but years later, you'll be glad you did. Remember, you don't need a lot of money to begin. Even small amounts add up over time thanks to compounding. Some people think DCA guarantees profit. It doesn't. If the market keeps falling, you'll lose money, just less than if you invested all at once. DCA does not guarantee a profit or protect against loss in declining markets. It only reduces the risk of bad timing. Others think DCA is only for rich people. Not true. You can start with pocket change. Many mutual funds waive minimums for automatic plans, and some believe you should stop DCA during a downturn. That's exactly the wrong move. Downturns are when you want to buy more. Think of it like this. When your favorite sneakers go on sale, you buy more. Same with stocks. Another myth, DCA is a market timing strategy. In reality, it's the opposite. It removes timing from the equation. You invest no matter what. DCA can be used with any investment, including bonds, ETFs, and mutual funds. It's especially useful in volatile markets. So don't let these misconceptions stop you. DCA is a tool for discipline, not a magic bullet. The key is to understand what it can and cannot do, and use it accordingly. Let's meet Sarah and Mike. Both are 25 and have $10,000 to invest in ABCD stock. Sarah puts her $10,000 all at once at $50 per share. She buys 200 shares. Mike decides to spread his investment out over 4 months, putting $2,500 each month. The market goes through a rough patch. The price drops to $40, then $30, then $25. By the end of 4 months, Sarah owns 200 shares worth $5,000. She's lost half her money. Mike, on the other hand, buys shares at each price: $50, $40, $30, and $25. He ends up with about 295.8 shares. His average cost is about $33.80 per share. When the market recovers and the price hits $80, Sarah's shares are worth $16,000, a profit of $6,000. But Mike's 295.8 shares are worth $23,664, a profit of $13,664, more than double. By spreading out his purchases, Mike turned a market dip into a huge advantage. Now imagine the opposite. The market rises steadily. In that case, Sarah would come out ahead. But the point is, DCA protects you from the worst of the volatility. And over long periods, the difference is small anyway. This example shows how DCA can turn a falling market into an opportunity, while a lump sum suffers the full brunt of the decline. Jordan works at a coffee shop and gets paid bi-weekly. She decides to invest $50 per paycheck into an S&P 500 index fund through her 401k. Over 10 pay periods, 20 weeks, the fund price fluctuates. Some weeks it's high, some weeks it's low. Let's say the prices go like this: $20, $16, $12, $17, $23, and so on. By the end, Jordan has invested $500 and bought about 47.71 shares. Her average cost per share is $10.48. The final value of her investment is about $1,097. If she had invested the $500 as a lump sum at the highest price during those 20 weeks, she would have bought fewer shares. Instead, her consistent purchases gave her a lower average cost. That's the magic of DCA. You don't need to be a genius. You just need to show up. Jordan didn't try to time anything. She just set it and forgot it. And that's exactly what most successful investors do. Over 20 years, that kind of discipline can turn small, regular contributions into a substantial nest egg. The Schwab study showed that over 20 years, the difference between lump sum and DCA was negligible. less than $1,000 on a $10,000 investment. So DCA might not make you rich overnight, but it will keep you on track. Jordan's story is a real-world example of how anyone can build wealth over time with consistency. So what's the bottom line? Dollar cost averaging isn't about beating the market, it's about staying in the game. It lowers your risk of buying at the worst possible time. It builds a consistent saving habit, and it frees you from the stress of trying to predict the unpredictable. The numbers show that over long periods, the difference between lump sum and DCA is tiny, but the behavioral benefits are huge. Start now, even with a small amount. Automate it, and don't stop when the market gets scary. That's when DCA works hardest. Remember, DCA does not guarantee a profit, but it gives you a disciplined framework to build wealth over time. The key is to start early and let compounding do its magic. Consistency beats timing every time. If this video helped you understand dollar cost averaging, hit that subscribe button. It helps the channel and keeps you in the loop for more practical money tips. And leave a comment. What's one money habit you're starting this week? I read every reply. Thanks for watching, and I'll see you in the next one.